So the outlook for financials is really positive from a fundamental point of view. The economy is doing well. It looks likely that we'll have a soft landing. The banks that we own are delivering really attractive returns. We think that interest rates will settle at 2.5% to 3%, which is a materially better operating environment than it was in the decade after the financial crisis. The insurance stocks that we own are seeing some really strong tailwinds in terms of pricing in certain subsegments. And the diversified financials are benefiting from some really attractive structural tailwinds. So against that backdrop, financials are only really just starting to perform well, which we expect to continue. If you look at the composition of the market, value sectors, including financials, are about a quarter of the market right now. But if you take that back to the mid-2000s, they were about half the market. So given the favourable fundamentals that we're seeing, we think there's pretty strong reason to be positive for the outlook. It's a pretty interesting time to be a global equity investor because everybody talks about equity markets being very concentrated, but we probably underestimate the degree to which that's the case. So we have a fantastic chart that shows the composition of global equities between sectors and regions, and it really highlights quite how extreme the concentration is in one particular sector, i.e. US technology. Now, our view isn't necessarily that that sector will perform poorly, but what we're saying is given the extremity of the positioning, investors should really think about diversifying, and we'd suggest that financials are an excellent place to do that.
Well, we've already seen a reassessment of the sector start to play out, which has outperformed broader markets over 1 year, 3 years, and since the Trust corporate action in April 2020. The catalyst has been a shift out of a period of ultra-easy monetary policy and into a more normalised interest rate environment. Despite the outperformance, valuations remain attractive, and we'd expect sustained outperformance in a scenario of a soft landing, while on a longer-term basis, a backdrop of 2 to 3% interest rates remains highly attractive for the sector. In terms of the key areas the Trust has invested in, we have a balance of both structural and cyclical themes, as highlighted on the slide, which also includes some example holdings. The structural themes include the increased allocation to alternative asset managers, which we view as a durable trend, with locked-up capital providing visible and recurrent earnings. Another structural theme includes the increased demand for data, a function of increased automation, the shift to passives and quant trading. This is benefiting areas like exchanges and information service providers that can monetize these unique data sets. Within the cyclical themes, we remain positive on the reinsurers, which continue to operate in a hard rate environment, while European banks' improvement in profitability is translating into a much higher level of capital return. We estimate on average a third of their market cap will be returned to investors over the next 3 years through a combination of buybacks and dividends. Lastly, we've identified turnaround opportunities, companies that are trading at deep discounts to their intrinsic value, and where we've identified near-term and clear catalysts for change. Overall, these themes give investors diverse exposure to global financials and highlight the opportunities for active managers investing within the second largest sector within global equities.